We have the S&P continuing to hit new all-time highs, something that also holds true for the Nasdaq, and we're about to enter a very large week of earnings because we're going to see some very notable names, those also in the Mag 7, where we have Meta and Microsoft reporting after the bell on Wednesday, and the following day we get to see Apple and Amazon, which will only help highlight where this market is going to go. Are we going to continue to see new all-time highs? And perhaps the news of the EU and US reaching a tariff deal will help the market continue to steam ahead. We also have to flag that we've now entered into extreme greed, and this is why today's episode is incredibly pivotal, because when we look at the S&P overall, what you're seeing here is a scale of 1 to 5 as to what companies analysts believe are a buy right now. And the trend, surprisingly or unsurprisingly, is that they see more than 90% of companies in the market as a very strong buy. So what we want to do is filter out those companies that are trading at some very ludicrously high valuations, and also filter those that have been performing very strongly in the last 12 months. We're specifically going to look at companies that are near their 52-week lows, and also those that analysts believe have some very nice upside. So less chatter, let's jump straight into the stocks. And we're kicking off with the railroad industry Canadian National Railway Company, down 15% in the last year. Year to date, down around 6%. Over the last 10, it is up around 54%, but you would have underperformed the S&P, and right now it's giving an opportunity to investors to consider adding near 52-week lows, and we get a double buy from Seeking Alpha and Wall Street. As always, quick analysis as well as our own interpretation of the valuation. And what we can see is the forward P currently of 16.6, not only well below the 5-year average of 20.7, but the cheapest on offer to investors at least for the last 5 years, indicating to us a severe undervaluation signal. Bear in mind, we don't look at this purely in isolation, but another severe signal here with the yield on offer today, 2.7%, when historically it's been below 2, and given the yield is higher significantly than the average, also worth pointing out the dividend safety score of 97 looking very safe is always nice to hear. We'll also flag the blue tunnel methodology, which points to us as being the intrinsic price when it's within the parameters or the fair value. We've noticed today disparity between where it sits and the bottom end. That is undervaluation, but something we've seen more often than not in the last 12 months. If we zoom out further in the last 5 years, very interesting to know, incredibly rare. In fact, from 2020, the only time you could have got this at a severe undervalued level would have been around the beginning of 2025 and some periods during this time frame. Otherwise, it's been in that intrinsic price, even severe overvaluation. Now, one key area that it does lack is the growth, where it sits at a D. Year on year, revenue pretty much flat. Revenue estimated this year at 2%. On both accounts, it is lower than the sector median, as well as being lower than their historical growth, which for the large part has been around the 3 to 4%. That is just keeping up in line with inflation. Earnings per share, nothing too spectacular, anticipated 8 to 9% in the next 3 to 5 years, lower than both sector as well as their own historical. And we'll also flag, and nice to see, that over the next 4 quarters they are expecting growth each one to the EPS. They hold a 75% track record, 3 out of 4 beats, trading on December 26 at a forward P estimated 15.7. And worth also flagging institutions, what they're doing with their 81% ownership. They've sold $4.5 billion, we're talking in just the last year, buying a little bit more at 5.6, but we've seen quite a lot more buying in Q2, 359 versus 15, so over the longer period and short term, they have been net buyers. Now, our intrinsic value, which we'll get to for each one of these companies today, is $116, the average of the 3 models. Now, typically, we do our in-depth dives of companies. We go through the inputs and the outputs. Today, we're going to get straight to it. However, what we will flag is the DCF model, because we've started to incorporate a reverse DCF process, which highlights what percentage of free cash flow growth is already baked into the numbers. And as you can see here, pretty much in line with the intrinsic value. As of today, CNI has around 10%. Now, incorporating our intrinsic value to the current price, we always like to use a margin of safety. 10%, we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, buy at 104, then we keep going till it's near the current trading price. Honestly, not that far off the 20% MOS point. Wall Street themselves, they see this $118 into the next year, upside of 24%. Now, this does look like one of those that could be for consideration if you do have a longer term portfolio. Dividend safety looks very safe. The yield is at the highest on offer, and typically it reverses to the mean, and valuation looks attractive. But give me your thoughts, and for consistency at 25%, expected by $87. Clearly though, this isn't a fast growing company as we've seen from historical data and future expectations. But in your view, CNI, buy, hold or avoid? Now, before we move on to the next stock, just to let you know, minutes ago we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of July. Lots of information for each one, the upside that Wall Street themselves see over the next year, and we'll be releasing August's copy in just a matter of days. And not only that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now, so click below, you can sign up and read straight away. The next stock we're moving on to is LMT. Lockheed Martin down 20% in the last year. Year to date down nearly 13%. Over the last 10 years, they are up 104%, but we can see a significant distance away from all-time highs at $619, trading very close to 52-week lows with a double buy from Seeking Alpha and Wall Street. And we also see forward P of 15 below the 5-year of 16.5, yield also above 3.1 versus 2.7, and the dividend does look secure at an 80 score. And whilst we do in fact get a reasonable valuation signal here, you can see it is very near to the bottom, so considering this could be a potential undervaluation signal. And if we zoom out to see severe undervaluation actually for quite a sustained period of time, it would have been around 2020 to 2022. Perhaps we will see that come up by the end of this year. Now, growth like CNI, nothing special at a C-, 1% year on year, in line with inflation expected moving forwards, which is in line with the sector, although actually a little bit above their own 5-year numbers. EPS looking promising though if they can hit on that 12.5% above both sector and their 5-year. But they don't expect any growth to the EPS in the next 4 quarters. Having said that, 100% historical track record, and into 2026, earnings per share just under $30, lowering forward P to 14.4. Now, institutions with their 74% ownership sold around $7 billion, buying nearly twice as much at just under $12 billion, but they have in fact been net sellers in the most recent quarter. Interesting to see though, for a very sustained period of time, they were net buyers, but actually in every single quarter in 2023, they were selling more than buying. Not something we've seen in the more recent period, but Q2, as we've said, a little bit more selling than in fact buys. Now, our intrinsic value, $507, average of the 4, which as always you can grab a copy of by clicking on the pinned comment below, will give you a margin of safety of at least 10% up to 457. At 20%, not quite there yet, would be a buy at 406. At 15 though, is pretty much around where it sits. Wall Street still fairly bullish even after the drop post earnings at $530. They see upside of 25%. Now for LMT, as we said, 20% a buy at 406, at 25, 380. But give us your thoughts at 15% MOS, 25% projected upside. Where do you see the company? Moving on, we have Fair Isaac Corporation down 3% in the last year. Year to date down 24%, pretty much losing a quarter of their market cap in 2025 alone. But over the last 10 years, still massive outperformance of the S&P. and we notice trading pretty much around 52-week lows, around $1,000 thereabouts from their 52-week high, and one buy rating from Wall Street 4.15 out of 5. And worth flagging, their forward P sitting at 52.4, and whilst their growth is a lot better than the previous two with a B+, remember valuation significantly above. Year-on-year growth as well as moving forwards to the revenue around 15%, actually higher on both occasions than the sector and their own historical numbers, with EPS projected 22% over the next 3 to 5, again looking like they're expected to grow both revenue and EPS faster than the sector and their historical. They also expect double-digit growth to EPS in the next 4 quarters, although 50% track record, notably most recent one was a 37-cent beat. Expected forward P still very high, but to drop to 42.1, and institutions holding 86% ownership, pretty much selling and buying the same amount in the last year. You could argue the same, a little bit of a difference in Q2, so they have been neither bullish nor bearish. And our intrinsic value at $1,661 derived from the DCF will highlight how we got there. Just one model. We've actually used a growth rate of 21%, which is the average in the last 10 years, although worth flagging, most recent was an increase of 31%. As always, we have the growth rate, the discount rate, which gives us the present value of future free cash flow and terminal price, where we add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get to 1661, and ultimately this in fact does show a small undervaluation signal. Typically though, we would run through the low at 20%, which would only be 1% upside, middle rate, which is where we would typically take through to the next stage, giving 44% upside, and for those that believe they will be able to continue what we saw in the most recent year, you're looking at 103, pretty much a double. Now we want to be consistent with how they have performed over the last 10 years, given how high it has been, but worth also flagging, already baked into the numbers is 19.9% of growth. If you believe it should be higher, then ultimately you see this as undervalued. If you believe it should be lower, then ultimately overpriced. In terms of a margin of safety at 10%, we pretty much see it not that far off there at the $1,500 mark. Wall Street very bullish even after the drop, $2,100, which actually isn't anywhere near their 52-week and all-time high. That translates to 37% upside. Again, for consistency, 15% about 1412, at 20% 1329, and at 25 1246. Fair Isaac Corporation, near 10% margin of safety, lots of upside according to Wall Street. Buy, in your opinion, hold, or in fact an avoid. We then move to Adobe, which is down 30% in the last year. Year to date, down 17%. Over the last 10 years, even with these drops, still outperforming, up 350%, trading near 52-week lows at $332, significant distance away from 52-week high, with a double buy from Seeking Alpha in Wall Street and a forward P that looks fairly attractive around the 18 mark. And we can also see if we incorporate other valuation metrics like the EV to EBIT, this also signaling severe undervaluation, well below their average and pretty much one of the lowest in the last 10 years. Now growth does come in at a C-, but honestly not the worst. We're talking 10 to 11% year on year and forward looking, higher than the sector in the mid-single digit, but the problem is they've been growing faster in the last 5 years, so are we seeing a bit of a slowdown? EPS doesn't tell us that story, expected 15 to 16%, which is pretty much in line with their historical and faster than the sector's 14 median. And green right across the board, love to see this. Nice beats in the last 4 quarters as well, and double digit projected every single one moving forwards. Forward P, November 26, expected to be around the 16 mark. And we see institutions, 82% ownership, selling 19 billion, buying more at 26 billion. And we also see a lot more buying in Q2, 1.7 billion versus 434 selling. Now, intrinsic value of $509 honestly is derived from an 8% growth rate, but you could also justify 10 as well as 12. Most recent year was 13%. Each one of these indicates upside, and one of the most telling signs of undervaluation is that in the DCF model, only baked into the growth is 3.5%. This is way too low, but let me know, perhaps you do disagree, you believe AI disruption is really going to harm this company. not something we have seen in the numbers. And if we do take it through to the next stage at the lower growth rate, so very conservative, we do get an MOS of 10%, in fact an MOS at 20%, at 30%, not quite there yet, you are getting at least 25%, up to $382. Wall Street $490 price target, 32% upside. Let us know where you sit. Perhaps you believe this one also severely undervalued. And we'll also flag at the middle rate, which is what we typically take through at 10%. You are getting clearly a larger MOS as you're expecting the growth rate to be higher. And as we keep on going, you're getting 30% up to 411. At 40%, not quite there yet, so sitting around the 35% mark. Overall though, Adobe, give us your thoughts. We then move on to Zoetis, down 16% in the last year, year to date down 7%. Over the last 10, continues the outperformance, up 213, trading near the 52-week low, a double buy, fairly decent from Seeking Alpha and Wall Street, 4.16, 4.1. And the forward P of 24, well below the 5-year of 32, pretty much the lowest in the last 5 years. Yield the same to be said, but the other way, 1.3, highest in the last 5 years, well above the average 0.9, and the dividend looks to be secure at a 74 score. Blue Tunnel also telling us not just today undervaluation quite severe, but for a significant period of time, at least in the last 12 months, one that's only been getting more and more undervalued. And when we zoom out to the last 5 years, there were some occasions where we saw severe overvaluation. Right now though, that is not the case. Growth at a D, year on year and forward looking around the 6% mark, not far off the sector around the 7 to 8, likewise their own 5-year numbers. And if we look at projected EPS growth, again very similar, 10% to both sector and their 5-year. Green across the board, again love to see this, with forward P anticipated to drop to 22.4, and institutions with 93% ownership selling $8 billion worth of shares in the last year, buying 50% more, have actually become net sellers in the most recent quarter, but overall they're typically more bullish than bearish on Zoetis. Now our intrinsic value, $210, we'll just highlight again because we have used the DCF model, that baked into the numbers on the reverse DCF is 9.8% growth. But if we look at it including both DDM as well as DCF, at $210 you are getting a large MOS, at 20% buy at 168, at 30% pretty much around that 147, 148 mark. Wall Street also see 33% upside, $200 into 2026. Not one we cover that often, so let us know, maybe you like it, or perhaps one not to consider. We then move on to Merck & Co, down 33% in the last year, year to date down 15%, over the last 10 years not great, up 46%, and we can note here trading near their 52-week low, all-time highs $128, both Seeking Alpha and Wall Street giving this a buy rating. And whilst we won't do an in-depth dive today, valuation A, growth A, and profitability A+. We also notice forward PE still below 10 even after a bit of a run in the last few weeks, 5-year average well above at 13, yield near 4% when historically at 3, so both of these continue the severe undervaluation signal, and fantastic to see dividend safety score 90, very safe, with another undervaluation point hit given the disparity, something we've seen pretty much from November last year. Growth, as we said, sitting at an A, revenue year on year and forward looking in the 4 to 5% region is actually lower than both sector median and their own 5-year, but one thing that looks a little bit stronger is the EPS, expected 10% against the sector, pretty similar, however their own 5-year a lot higher at 17. If you want to look at the other metrics though, we can see significantly above both historical and the sector comparative. They do however expect 3 of the next 4 quarters to be growth, pretty much 100% track record at a bare minimum in line, and forward P dropping to below 9 in 2026. We also see institutions with 76% ownership selling 17 billion. They've bought nearly twice as much at 29 billion, more buying again, so very consistently bullish more than bearish. And our intrinsic value, $108, the average of the 3, will give an MOS, but again consistency on a DCF model, very interesting and surprising in fact to see. Baked into the numbers is a decrease of 2.5% year on year. So talking about margin of safety, at 10% a buy at $98, at 20% $87, at 25 not quite there yet, sitting somewhere in the 20 to 25% region. Wall Street still bullish, $104, 24% upside. Merck & Co., what do you believe? We then move on to Novo Nordisk, down 44% in the last year. Year to date, down 18%. In the last 10 though, still slightly outperforming the S&P, up 144, trading near the 52-week low. All-time high feels like so many years ago at $140, and we notice a double buy from Seeking Alpha and Wall Street, with a forward P sitting around the 17 mark when the 5 year's been at 30, yield at 2.3 when historically at 1.4, again two undervaluation signals, and their dividend safety score 99, very safe, in fact the highest score obtainable, and we can also see here severe undervaluation. Remember, this is one of our favorite things to see when the fair value of a company continues to climb, but we see the opposite, share price decreasing. That is typically a good time to consider, and over the last 5 years, in fact, there's not been that many times where this company was severely undervalued. It all started in 2025. Now, growth at a B, very strong. We're talking 24% year on year, 21% expected this year, not only above the sector median, but also significantly above their own 5-year numbers. EPS also looking strong at the 13% region, when sector sits below 11, but we notice their own 5-year a little bit higher at 14.8. Now, they do expect the next 3 quarters to be strong double-digit growth with a 75% track record, but nice to see last 3 quarters were all in fact beats. December 26 forward P estimated drop to below 16, and institutions with their 12% ownership selling 6 billion, buying more than 7 billion, and also a lot more buying in Q2, so net buyers quite consistently over the longer term. And our intrinsic price at $82 is derived using a growth rate of 14%. Baked in already though is 11.7, so interesting to hear your thoughts whether that is too high or does still leave room for growth, but pretty much at the 14% point you are getting a margin of safety of around 10% at 74. 15 is where we see this today. Share price is sitting around that $70 mark. Wall Street still bullish, $97 price target, 37% upside. They believe this one for serious consideration, and we can highlight at 12% the margin of safety, but pretty clear and obvious, you're barely even getting 5%. That would be around the $68 to $69 mark. Novo Nordisk, one to consider or one to maybe hold off on. We then move on to Lululemon, down 11% in the last year, down 43% year to date. What a drop. And over the last 10 years, they've somehow still managed to outperform the S&P, up 251%, trading at a 52-week low. Perhaps we're going to see a new 52-week low today, the way things are going, with 2 weak buy ratings from Wall Street and a forward P that now sits below 15. And actually, if we do take a look at this, we can see they are trading at their lowest P ratio in over a decade. And whilst growth does sit at a D+, we're talking 9 to 10% last year, 8% projected moving forwards. Yes, above the sector, but we can see this company historically growing at some very impressive numbers. Earnings per share, a little bit of a letdown at 10%, not given the sector is the same, but actually their own 5-year was a lot more at just under 18. And we can see whilst they're projecting growth in 3 of the next 4 quarters, we are talking about low single digit. But having said that, they have been either in line or outperformed in the last 4, so maybe we will get a very large surprise, with January 27 forward P sitting at 14.1. Now, institutions, 85% ownership, selling 6.5 billion, buying a little bit more. The same to be said in Q2, so no real clear indication whether or not for the time being they're more bullish or bearish. And our intrinsic value at $316 derived using a 6% growth rate, which again, as always, you can grab a copy of to run your own numbers, whether it's for Lululemon or any others. But really the main takeaway here, baked into the growth is less than 1%, so you could consider that perhaps an opportunity to consider at the bare minimum. 4, 6 or 8, no matter which one you use, you are getting a margin of safety as well as upside. Taking through the middle rate, we'll just highlight that exact figure. 10% a buy at 284, 20% still a buy. At 30% is where we see this. Wall Street themselves, very bullish, 295 price target, 34% upside. Give us your thoughts on Lululemon. But we'll also flag, if we take the lower, more conservative rate of 4%, you are still getting a margin of safety. At 20% is pretty much where we see this. So opportunity, only if you do believe in this in the longer term, but let us know. We then move on to UPS, which is down 20% in the last year. Year to date, also down the same. Over the last 10, pretty much flat. So if you'd invested $10,000 10 years ago, you'd be holding the exact same today. But if you factor in inflation, you would be sitting on a lot lower in terms of purchasing power. Trading near their 52-week low, a double buy from Seeking Alpha and Wall Street. And we see a forward PE below the 5-year average, yield at 6.3%, well above the 5-year at 3.5%. But very important to highlight, their dividend safety score does sit at 50, borderline safe, could in fact signal that we may be seeing a dividend cut in the shorter term. But one thing that also backs it up, if you just look at their growth, it has been very below par, 0.6% in fact the most recent year. But on the blue tunnel, we do get that severe undervaluation, and growth doesn't look great at a D-. We're talking 1% year on year, -1 projected this year. Sector and their own 5-year average looking a lot better. We're talking positive near the mid-single digit. Earnings per share 7% projected, lower again than both sector and their own historical, and they only expect one of the next 4 quarters to be growth, although they have a 75% track record with the last 3 being beats. Trading December 26, 13.3, and institutions 60% ownership, selling 8 billion, buying 50% more at the 12.2 mark, highlighting their net buyers and more bullish case in Q2 with more buying than selling. And our intrinsic value at $128 will give an MOS, but again for consistency, baked into the DCF is decreased to free cash flow year on year of 1%. In terms of margin of safety then, you're getting 10% up to 115, 20% is where we see it today. Yield of over 6%, as we highlighted though, doesn't look the safest. Wall Street 122, 18% projected upside. We then move on to Lowe's company, down 5% in the last year, down 7 year to date. Over the last 10, they have outperformed up 229, and we see it trading near the 52-week low. Double buy from Seeking Alpha and Wall Street, with a yield not too dissimilar from the 5-year average, so a reasonable valuation signal, but yield a little bit above 2.1 versus 1.9, and nice to note, dividend safety 93, very safe score, with a reasonable signal pretty much sitting slap bang in the middle of the blue tunnel. But over the last 5 years, actually there was a significant period of time where you could have accumulated in a severely undervalued level, and the growth at a D, not good at all, -3% year on year, barely even 1% projected moving forwards, lower than both sector as well as their 5-year. We're talking still low, but at least in the positive region. EPS projected 6%, quite some way below sector at 10 and their historical 13, but we do see green right across the board. Nice to note that consistency. January 27, forward P anticipated below 17, and institutional ownership 74%, 7 billion worth of selling, 13 billion worth of buying, has been flipped in the most recent quarter, although a little bit more selling than buying. More often than not, as we can see, institutions have been net buyers, and our intrinsic value $271, pretty much in line with where Wall Street see this next year, indicating 19% upside. Does actually also flag a 4.1% growth to the DCF. Let us know where you believe that truly should sit. We've gone for 6% as an FYI, but overall still margin of safety appropriate. 10% about 244, at 20 not quite there yet, and if you wanted to see just for consistency 25, 203. Right now though, we are talking around the 15% mark. Lowe's company 15% MOS, 19% upside. Give us your thoughts, and as always, don't forget to sign up to the free weekly newsletter. Come and join us at Patreon, where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.